podcast. This is Dr. Ryan Peckham, and this is episode 160. On today's episode, we're going to talk about the month of February and how up and down it has been. The market has definitely churned around a little bit, and there has been some up and down sideways movement. So we will discuss why that has happened. We'll discuss some of the earnings reports that have come out that have impacted the market, and we will also talk about strategies to help you reduce the volatility, the swings in your portfolio, and make sure that you are setting your portfolio up for success in this ever-changing market. So, as always, get your mind right and let's get to work. Welcome back to the show, everybody. My apologies, man. February just went by quick for me, and we did the episode for the Super Bowl, and then I thought, okay, I'm going to do an episode, and then the month just flew by. So I apologize for the delay in getting episodes done. So try to make sure that doesn't happen in March, although I'm pretty sure March is going to be busy too. So we look at the markets here. Completely different from where we were in January. We have the NASDAQ going negative for the year right now. We have the S&P barely hanging on at 1%. And we have the Dow leading the way at 3% for the year. So we have a lot to discuss. It has been a very just kind of up and down market so far this year, especially in February. There's been a lot of risk off moments where investors have said, man, I think I'm just gonna watch this from the sidelines. So whether it's companies reporting earnings, or whether it's the political risk that's out there, there's just kind of a lot of uncertainty in the market right now, not knowing what the tax code's going to do over the next year. And so just a lot of risk that the market really doesn't know how to price, where to look at it. You look at the last 2 years, we talked about this already, good years in the market, and people saying, you know what, I think I'm just going to take a little bit of this off the table, and I'm going to just kind of wait this one out. So we will discuss that. We will discuss a couple other things. Home buyers this past week, the mortgages, 15-year, 30-year mortgage came down a little bit on the rates. So we'll see how that impacts home buying season over the next couple of months. And so when you look at it on Friday, there was the PCE number came out, showed that incomes were up, but that individuals are actually saving more money. So that is not something you hear a lot, where individuals are actually saving more money. So why would investors save more money? Well, it could be a couple things. Could be that they don't feel like the economy's going as well as they thought it would, and so they think maybe there's some trouble ahead. That could be one reason. It could be that, another one is we're right past the holidays. And so there's many people who are like, man, I bought a bunch of stuff in November, December. I should probably save the first couple months of the year, so that you probably get a little bit of that together. You look at some of the company reports this past week. Nvidia reported. I thought it was a pretty good quarter. The market did not agree with me. For a while it did. I mean, Nvidia was looking pretty good, and then it sold off. And then Friday we had a bounce. I do want to educate you a little bit. There is a kind of an investing term called relative strength index. And it kind of looks at stocks and how they're trading. Are there a lot of people, or I shouldn't say people, I always say that. It looks at all the investors that are piling into a stock. How much have they pushed the stock up recently? Has there been a lot of activity in a stock? And so it kind of oscillates from 0 to 100. And so the higher it is, means that there's been a lot of people in there. So you can go to a website called Stock RSI. Stock RSI is a good place to go to kind of look at this to see what's going on here. But it's really, it's a technical indicator. It's a momentum indicator that shows you how much has the security price changed in either direction, so up or down. And so how you read this is you look up, I do this all the time. I'm looking at different stocks, and okay, I'll go to that stockrsi.com, and I'll say, okay, has this stock over the last couple of weeks or months or whatever, has there been a lot of momentum in the stock, a lot of momentum traders in the stock? And if that's the case, the reading on that will be above 70. Okay, so above 70 means there's a lot of people in this stock, a lot of momentum in the stock, a lot of activity in the stock over recently. If it goes below 30, that means a lot of people, a lot of investors have sold out. There's negative momentum on the stock. And so what you can kind of, somebody's going to hit me up and say, you can't say that, but it's like, okay, above 70, you want to look to say, okay, maybe I want to sell a little bit. Maybe I want to trim some of this. Maybe there's a little bit too much momentum in this stock, which could have been like a Palantir when it hit 124. We trimmed some Palantir at about 118. And so the stock RSI for Palantir got way up there. Whereas when it gets below 30 and below, you're sitting there going, there's a lot of negative momentum in this stock. Maybe this is where I need to add some shares. So this strategy helps when you have a market that is churning over, like the market that we have right now. So, there's a lot of political risk. Something comes out, market sells off. A couple days later, it changes, the market rallies. And so you have to be careful with this. You can't just, do it on everything. I mean, you don't want to cause yourself a tax issue because you're trading all the time. This is definitely not, definitely not me telling you to try to day trade or anything like that. That is not what I think people should do. But when you have a market that's kind of rolling over like this, these are just indicators that you can use that when you're thinking about dollar cost averaging into a position or you're going to add some money to your portfolio, this is one of those things that you can check. So I spend all this time to tell you this because when you look at some of the stocks that have been really beaten up over the past couple of weeks, which is going to be kind of the Mag 7, some of the momentum stocks that have been out there, just going through those this weekend, looking at them, I mean, some of these are so low. Some of them, I think the NASDAQ as a whole, the RSI for the NASDAQ as a whole is at its lowest RSI, relative strength index, since the low in 2022. So there are a lot of investors who have been pulling out of the market, negative momentum, negative sentiment. A lot of it's based on tariffs. Instead of this week, instead of Taco Tuesday, we're going to have Tariff Tuesday. So it's getting hard for the market to keep up with all the tariffs. Are we putting tariffs on Canada, Mexico, the European Union, China? It's like Oprah. It's like you get a tariff and you get a tariff and you get a tariff. So the market has issues. The market doesn't like uncertainty. And so when you have kind of this political tug of war, where you have somebody who likes to negotiate in the public eye, so you see a lot of stuff, when you have a kind of politicians that like to negotiate in front of everybody, you get a lot of this churning and this political risk. Even though you might end up in a good place, getting there sometimes can be quite painful. So you have to think about that. And not everything is a call to action. Not everything is saying, hey, I should make a trade, I should sell. Not everything is a call to action, especially if you look at your time horizon. You have to make sure that the companies that you're investing in, that you're okay holding them, and you have to have kind of a list of companies that if they do get beaten up, that you want to be able to invest in them. So when you look at, some of the companies that have been momentum plays or went up a lot and then came down. I mean, Palantir right now is at $85 a share. And before they reported their last quarter, they were at $85, $86 a share. So you already know that their earnings were good and they've come all the way back down. And so it's like you get the last quarter for free. So that's what I kind of look at. I'm looking at, okay, where was the company? The companies that had good earnings went up, came back down. Are they now below where they were when they reported earnings. And so the other key for this, and this is where, again, dollar cost averaging and saying, hey, I'm going to put so much in per month or every week or every 2 weeks. I mean, this is where that pays. And so obviously, maybe after having 2 good years, maybe we don't want to have as much offense in our portfolio. So when you think about the couple different things that you can invest in, and we call this asset allocation, you can look at, I can invest in equities, I can invest in fixed income, I can invest in, precious metals or whatever it's going to be. But you look at stocks, equities, and you say, I'm going to be part owners in those businesses. I'm going to be a participant in the profits and or losses of that company. And so there's going to be more movement there. There's going to be more risk, but there's also going to be more reward. Well, if you want to be more defensive, you could go into the fixed income space, which is like being a lender, where you're lending companies money or you're lending a bank money for a CD. You get a lower, expected return on those, but they also are contractual instruments and they reduce the volatility of your portfolio. Now, they also, they limit the maximum amount of expected return you're going to have in your portfolio, but they also reduce the risk of your portfolio. And because they reduce the risk, the volatility, which volatility is measured in your investment account as standard deviation, which is the swings. How wide are the swings? And that's what gets people. When you have massive swings in your portfolio, it makes individuals nervous. It makes investors nervous. They don't enjoy it. And so that's what every money manager is typically trying to do, is give you exposure to growth, but also limit the standard deviation, the volatility of your portfolio, because they understand that, well, most of them do. They understand that the more volatility there is, the more nervous as an investor you're going to be, which would cause you to be more likely to sell out of your investments, which they don't want you to do. So that's one of those things that you have to determine, for yourself, what kind of investor are you and how much risk are you willing to take? And so, I look at this and it's always, Charlie Munger here, which is invert, always invert. And so when you have investors that are nervous, I start looking around and saying, okay, well, what are the things that those investors are selling? What are, how are these going to maybe later on be, are these going to recover later on? And it's a good spot for me to be able to buy more shares or look at that. The other thing that you can do in your portfolio to help you ride out these kind of, again, where we're trading, we call this trading sideways. So we go up, we come down, we go back up, we come down. So, but we end up staying in the same place. So that's why it's called trading sideways. So when you have a market that's trading sideways, it's imperative that you have dividend paying companies within your portfolio, because those dividends are going to bring income into the portfolio and they help you ride out these trading sideways periods where you could either use that income for your lifestyle or you could reinvest those dividends over time. Because there are some markets, there's some years where the market truly doesn't go, a lot of places, and those dividends that you're reinvesting is the return that your investment has over that year. So again, it depends on where you're at on the risk spectrum. It depends on what your time horizon is, but you do have to kind of prepare yourself emotionally for the fact that there is going to be months where, like February was, where we really didn't go anywhere and we kind of went down actually. And so doesn't mean the year's not going to end up good, but it does mean that it's probably going to be a different year than in years past. And again, I'd like to reiterate that, some of the political stuff going on, those kind of things can add volatility to the market because of the uncertainty they provide, where, again, you could have companies that are doing great things, but it's going to get overridden by the political risk. So if you know that a company has reported good earnings, and you know that, you've done your research on that company and you're comfortable with it, well, then when everybody else is nervous and they sell off, I mean, that's your opportunity to say, okay, I'm going to buy back in. And if you have maybe a tax deferred account like an IRA or whatever, when the market goes up and everybody's kind of feeling euphoric again, you can trim a little bit of that. And then when it comes back down, and I say the tax deferred accounts because you wouldn't have to worry about taxes. And then when it comes back down, you could buy those shares back. So again, I think we did an episode called Trading Around a Position, and that's kind of the key to that is you can trade around different positions. And you can also move some of your funds to some of the more defensive stocks, but then also some of the more defensive asset classes, which would be fixed income and some of the others. So it's definitely a conversation you should be having with yourself or the advisor that you're working with. All of those things are going to be important. Speaking of, so the other reason that I haven't done an episode in a little bit is because my firm has been growing very quickly. And last year we passed SEC registration and we grew a ton. And I finally had to say, okay, Mercy, I need some help with compliance. And so compliance is not a lot of fun. Sorry if you're a compliance person. It doesn't mean you're not a good person. It just means it's not fun. There's a lot of stuff you have to do with compliance. So I've done a lot of meetings over the past week or two with some compliance companies, some people that are going to help me out, outsourcing my compliance and helping out. And they said, oh, you have this podcast. Do you do a disclosure? And I said, yes, I do a disclosure. Well, my disclosure isn't good enough. So simply telling you that, I'm not your financial advisor, all that. So at the end of this episode, we get a brand new nice disclosure that is going to be, 4 lines long that I get to read on every episode now. So that'll be entertaining. Maybe I'll do it after the theme music. So, kind of doubling back to what we've been discussing, make sure when you look at your portfolio, you look at the holdings that you have, that they're things that you like. Because when investors get nervous and things you like and you believe in and you want to be invested in, when investors get nervous, they're going to de-risk their portfolio. Money managers are going to de-risk the portfolios. So that means, selling some of the higher risk assets, which are going to be some of the ones over the past couple of years that have done really well. But I don't know if I have to define de-risk or risky or stocks, but it's going to be some of the AI stocks on the fringe. It's not going to be the Johnson & Johnson, Coca-Cola, Procter & Gamble's. That's where they're going to move the money. So when you look at, just going back, when you look at the dividend discussion that I just had, those are some of the investments that money managers are going to go look at. So a company having a great year, AT&T. We haven't talked about AT&T in maybe years, but AT&T, if you would have invested in it 5 years ago, so this is March 1st of 2020, it would have cost you, $26.71. AT&T today is worth $27.41. So you'd been up 3% if you bought it 5 years ago. And it got down as low as $14, $15. So AT&T has not had a good 5 years. They've had a very good year to date. They're already up 20%. So what happened here? Well, AT&T, which owned DirecTV, and they also own Time Warner, for some reason, when everybody else is starting to get into streaming, AT&T thought it'd be a good idea to buy DirecTV and satellite dishes. So their old CEO did that. Their new CEO has been, selling those assets. He sold Time Warner, sold DirecTV. AT&T had a lot of debt, and so they've been paying down that debt, turning the company around, which now you're starting to see in the numbers because their earnings per share have gone up, their debt has started to come down, and you start to see the momentum in their financials, which is what is starting to push that stock up. So AT&T even though the stock looks on paper, the share price looks the same as it did 5 years ago, the company is in a much, much better position. Now, is this because I've had like 4 MBA students go work for AT&T? I mean, maybe. I hope that's what I tell them. But AT&T is a much different company than it was 5 years ago, and that's because of their debt structure, all of those things in their financials that we have to pay attention to. And, put the asterisk on here. So when you're going and you're looking at companies, you need to make sure, looking at the debt, are they adding debt? Like that is one of those things in their financials that can really hurt you. So you look at like AT&T's up 20%, and Nvidia for the year now is down 7%. So that's kind of interesting. You got Nvidia down 7%, AT&T up 20%. So again, there's a shift from taking risk levels down in portfolios. We've done well on Nvidia. Let's take some profit and let's move it to something that hasn't done well. AT&T, the company looks a lot better. Let's shift some of the risk. They pay a nice dividend. So you're seeing this happen live with all these companies where there's a shift from riskier assets to more stable dividend payers, maybe things that have been beaten up. And so, you look at your portfolio and you kind of start making those decisions. All right. Well, as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.